but what if for my company I projected out every year's cash flow based on, because it's a EV company in China, so I try to I projected out all of the car unit sales for every year for the next 10 years.
So you got revenues and what else?
Yeah, like the revenues, the service revenue derived from each unit.
Right.
So every EV you sell, they have a monthly, like yearly membership that includes insurance.
So what have you projected out? Revenues and operating income and all the way through to your cash flow?
Yeah, because I use the units to determine like how much operating leverage I get each year, and then like with that I get like the amount of. So all my whole model is dependent on like changing the units to get scale.
So what do you have in your projections? Revenues every year, what else?
I have revenues every year. I have like service revenue, unit revenue. I have the cost, and then
So your operating income every year?
Operating income every year, and then I have the free cash flow. So I got it down.
So why do you need the model? You already have everything. So all you need to do is put a terminal value at the end, right? So why do you need to put it into my model then?
Oh, because like all my friends told me like, oh, you don't like you need to use one of.
No, if you already have the cash, just make sure your cash flows are internally consistent.
Okay.
Right. So if you make sure you're putting in reinvestment that matches your growth rate. So if you have revenues and cash flows every year, you don't need to put it in the model.
Yeah, because I try to move it over, and then I was like.
Because the only way you can move it over is actually replacing each year's numbers.
Each year's numbers, yeah. So I think,
which would be more work. Yeah.
thank you.
So did any of you see what happened during that battle last night? I couldn't see a thing. Scott, I don't think they even shot anything. I just think they showed haze, saved themselves a lot of money, but no. So I also learned a very important lesson, which is when you send these newsletters out, I have 3 classes, I kind of juggle them in the air, sometimes I drop a ball. And on the last newsletter, for those of you who read it, this is the test of how many people actually read my newsletters, there was a typo that was consequential. You know what it was? I'm sorry? No, I gave you a final exam date that was wrong. I told you see, you didn't even know that. It tells me you don't even read the newsletter. So good, then you're not confused. But in the newsletter, I said your final exam would be on May 20th. It's actually May 17th. There will be an earlier final on May 14th. For some of you, I know you have a clash, so that's a Tuesday of that same week earlier. So I'll send you the specifications, but that you have to sign up for because there are only a certain number of seats. So I'll let you know when that is going to be. Okay? So today we're going to continue to build on real options. So any questions before we start? So again, remember the clock is ticking, 5 more sessions. You're going to get more nagging from me to make sure you get done. But we're talking about options. In last session, we talked about the value of undeveloped reserves in an oil company or in any commodity company as an option. Okay? And where does the option value come from?
The option to delay.
The option to delay comes from the fact that you can produce the oil right away, but you could wait and maybe oil prices will go up. And because you get to observe the oil prices, there's optionality, which allows you to add a premium on top of the value. I want you to hold that thought in your mind, because today's start of the class test is going to be built on something that comes out of that option. So let's suppose I came to you with 2 oil companies, right? Royal Dutch and Petrobras. Let's say they have the same value, both companies. But here's where they're different. Petrobras gets a bulk of its value from undeveloped reserves. Royal Dutch gets a bulk of its value from developed reserves. Assume that they both have the same value. Right? So today they're both valued the same, but one gets a bulk of its value from undeveloped reserves, the other gets it from developed reserves. Now assume that oil prices jump from $60 a barrel to $100 a barrel. Something happens in the Middle East. Okay? So what will happen to the value of the 2 companies? They'll both go up, right? And which one will go up more? Petrobras will go up more, you think? What do you think? Royal Dutch will go up more? There are 2 components of value. There's developed reserves and undeveloped reserves. So when oil prices go up, both will go up. So my guess is they'll both go up. I'm not even sure which one will go up more. But now I'm going to make it interesting. You know how Middle Eastern crises come and then they go? That's like, it happens. Did you dream that? No, it's like, So let's assume the day after it drops back to $60 a barrel. Everything's back to to what it was, right? So now comes the interesting question. So 60 to 100 back to 60. I look at the values of these two companies again. Nothing's changed, right? Or has something changed? What did that 2-day window do to you? Yeah.
Petrobras could have had the potential to exercise their option.
Oh, that's going to be very tough in one day. That's going to be very, very difficult. So let's assume that away. Yeah.
I think one company moves to develop, and then they have some fixed cost related to moving to develop.
You're assuming too much happens in one day, right? It's Monday, Tuesday, Wednesday. So Wednesday you're back. Nothing, nobody in these companies even comes into work Monday and Tuesday, I think. Oil companies, what are you going to do? Yeah. You're getting close. What's the volatility we use in option price to value these? When we talk about valuing undeveloped reserves as an option, we use a volatility, right? Where do we get that volatility? We might look at the past prices, but the reality is the perceived volatility. Did these 2 days change that perception? No, it's going to be a much higher volatility. Holding all else constant, you know what's going to happen? 2 days later, same oil price, Petrobras is now going to be worth more than Royal Dutch because so much of its value came from the optionality. The point I'm trying to make is when we value commodity companies, we tend to think about the commodity price. Of course it matters. Oil prices matter for oil companies, but we also need to think about oil price volatility because that too can affect the value. There are lots of shale oil companies now where the reserves are actually non-viable. And those reserves are like out-of-the-money options. As oil prices become volatile, you can expect to see their equity values kind of reflect that optionality. Now, I want to add one more tool to your arsenal. You know how to value call options. So let's assume that Petrobras is now offering these undeveloped reserves for sale to the highest bidder with a caveat. And here's the caveat. If the price per oil exceeds $150, the winning bidder has to pay the extra amount back to the Brazilian government or to Petrobras. So basically, you get the right to these undeveloped reserves, but unlike regular rights where you get them at whatever price, I'm going to put a cap on the price. Is there a way I can first, tell me what the cap is going to do to the value of, so you're bidding for the undeveloped reserves, what will happen to the value of the reserves? You're going to pay less, right? Is there a way I can value how much less? You could. There's actually a simpler way. You could do a put option, but you can also, you know what a capped call is? In a capped call, think of this as a payout value. A regular call, the price keeps going up. In a capped call, you actually stop making extra money. Okay? So all you have to do to value the call is value two calls. One with a strike price at 60, one with a strike price of 150. Subtract out the value of the second call from the first one. It's actually a I did this just to give you that technique to use. Anytime you get an option with a cap or a floor, which you often get in options, this is a very easy way to value caps and floors. Just value an option at the cap or the floor, and you have a way of bringing into your option value. So I could give you, look, you can get 10% of the profits on the company up to $1 million, and then it's capped. This will give you a way of bringing in that cap into how much you're willing to pay for the option. So just use traditional option pricing, but value two options, one with a strike price of 60, one with a strike price of 150. Take the difference between the value of the two options. That is the value of a capped call, where the cap is at 150. Okay. So let's go back, because today I want to talk about what the option that excites people the most. I know it's tough to get excited about real options. There are actually sick people who actually get excited about options. But you're going to see in a minute why this option creates so much excitement. We've talked about the option to delay, and we applied in two contexts, one to value patent and one to value undeveloped reserves. And we talked about where the optionality came from, right? The exclusivity. With the patents, the exclusivity came from the legal protection you got, and with undeveloped reserves, the exclusivity came from the fact that there's only so much oil under the ground. Okay? And I use the example of real estate in Manhattan to illustrate what happens when you have natural scarcity. Today I want to talk about the option to expand. So let me structure the option. Let's suppose I gave you the rights to take a project. I asked you to take a project in China, and I gave you the cash flows, and I said, hey, based on the cash flows, the project has a negative net present value. What does traditional corporate finance tell you to do? Don't take the project. So wait. Before you reject the project, if you take this bad project, I'll give you the rights to a second project. And right now, that second project is even worse. This is going from bad to worse. So I'm giving you a bad project with the rights to an even worse project, right? But the second project is a right. So let's say the first project was those 10 hotels Marriott opened in China, negative net present value. But the second project was the right to open 100 extra hotels that right now don't look good, but if things change, could become valuable. Do you see what the option lies here? It's not the first project, it's in the second project. And if I were to draw the payoff diagram on that second project, here's what it'll look like. The cost of expanding becomes the equivalent of the strike price. The value of expanding becomes the equivalent of the stock price. You will expand if the present value of the cash flows is greater than the cost. And if that never happens, what you lose is the negative net present value in the first project. So I'm going to take a very simple example to illustrate this and then extrapolate from there. Let's assume you came to me with a company that produces an antivirus software. You ask me to value it. I do a traditional discounted cash flow valuation. I come up with a value of $115 million for the company. My DCF is done. And then you say, look, we're an antivirus software company, but as we sell this product to customers, we're collecting data on virus attacks and our customer needs. And over time, we're going to get a database of software vulnerabilities that we can perhaps exploit to sell a second program, a database software program, sometime over the next 5 years. So what I'm accumulating is data about you as customers, and maybe I can use that data to say, so I ask you, well, how much do you think you can make? And you say, well, I think I can make about $40 million a year for the next 10 years from this. It's a very rough estimate, you don't know. But it'll also cost you about $500 million to produce this database software. So right now, you can already see this is not going to be a great investment if you took it today, right? You have $500 million you're investing. You make $40 million a year for the next 10 years. Even without present value, that's only $400 million. And if you put a discount rate of 12%, that present value is going to be even lower. So what am I giving you? You're essentially saying, maybe I can think of something to do, but right now there's nothing viable. But you have 5 years to make this decision, and there's a huge amount of uncertainty in this business. There's a 50% standard deviation. Say the riskless rate is 3%. This is an option, right? You have for the next 5 years an option to take the project. It's a deep out of the money option because the present value of $40 million for the next 10 years is $226 million. It'll cost you $500 million to take this investment right now. So you'd be crazy today to do it. But here's the thing. You know nothing about this business. There's a lot of uncertainty. And you're going to make ignorance and uncertainty your allies now. Because you're so uncertain, there's a standard deviation of 50%. If I value the option, I get a value of 56 million. This is almost like magic. Now do you see why people get excited about this option? What do I reward you for? For ignorance and uncertainty. And the more ignorant and uncertain you are, the greater the value of the option. You're saying, when would I ever run into something like this? I mean, you've probably heard talk of the values of platforms. I hear it now with Uber, right? Which is you can value Uber as a ride-sharing company, but it's a platform. What's a platform? There are 91 million riders on Uber, and Uber is collecting data on you, and maybe they can do other stuff with you. With Uber, that's a tough sell. But when I valued Facebook last year, and I came up with $180 per share, it was like March or April, right after that Cambridge Analytica scandal, I valued about 180. The stock was actually trading at 155, but let's say it was trading at 177. Now, normally when you value a company at 180, it's trading at 177. Your reaction is, hey, there's nothing to be seen here. It's a fairly valued stock. But with Facebook, I'd have bought even at 177. And let me explain what I'm paying for. When I valued $180 per share, I valued it based on its core business, which right now is what? How does Facebook make all of its money? Not from invading your privacy, but from selling you advertising. The fact is they have to invade your privacy to sell you focused ads. It's their business model. So I value them as an advertising company. But you see where the real option comes in? They have 2.3 billion users. Think about that. That's kind of scary, right? But here's an even scarier statistic. 57 minutes a day. You know what that number is? That is how much time an average Facebook user spends on Facebook every single day. And I'm not even counting Instagram and WhatsApp. 1 hour of every day, 2.3 billion people are in the Facebook ecosystem. Right now, Facebook is just selling them advertising. But could they sell them other stuff? Yeah. They could do it on, they could be a retail company, they could be an entertainment company. You see the optionality here? And I haven't counted any of those cash flows because I don't know what they will do. They don't know what they will do, but I do know this is icing on the cake. So you know what that means? With Facebook, even though the price is very close to value, I would still buy it because so I don't even have to put a number on it. I might not even be able to put a number on it because the numbers are too fuzzy. But the very fact that there's optionality is going to create that value. And that's why this is such a dangerous option, because you can already see you can justify yourself into buying something just because you want to. So I'm going to give you a couple of tests I run whenever, because I hear this all the time with platforms, with big data, really talking about real options. Let me go through the 2 questions I would ask before I jump in and pay that premium, because that's effectively what I'm doing. The first is, do I have to make the first investment to get to the second one? Remember the Marriott example where I made you lose money on 10 hotels to open the other 100? If I can do a market test and get the same information, why would I want to open the 10 hotels? So that's the first question. But here's the second one. This is more critical. If I take that first investment and it pays off, how exclusive is my right to the second investment? That 100 more hotels? Am I the only one who's going to be able to do this, or are there 5 other hotels lined up? The more exclusivity there is, the greater the value to the option. I have a very simple saying when it comes to things like big data and platforms. If everybody has it, nobody has it. There's got to be some exclusivity in this process for a real option to have value. So you're saying, where is that exclusivity going to come from? You can list out competitive advantages, because that's what exclusivity comes from, some barrier to entry. At one limit are absolute barriers, which is what you get with legal protection from competition, a patent. And as you go down, you can see licenses, brand name, and the weakest of all competitive advantages is I was there first. If that's all you can think of is, hey, we were there first, then I'm a little worried about what your competitive advantage is. So with Facebook, is there exclusivity? Yes, their ecosystem is their ecosystem. You might not like it, you might have bad feelings about the privacy invasions, but it is their ecosystem. But I'll give you a contrasting company. No, you don't have to deal with this in New York, but you've heard about the dockless scooters that are taking over entire cities, right? I live in San Diego, and I live in mortal fear of getting run over every 5 minutes, because you got crazy people on scooters who are half drunk or fully drunk or twice as drunk as they should be, driving down the sidewalk, mowing down people as they go. And I've never understood that dockless bike business. Now, I don't see it as a business model that actually makes, I don't see how you can make money. First, you charge absurdly low amounts to get these bikes, and second, the wastage you must have in terms of capital equipment must be huge. Bikes get abandoned in strange places. In my neighborhood, I have people who pick up the bikes and throw them into trash cans because it's pissed off at, I don't know how much a bike costs, but in a trash can it's definitely worth zero. And I probably mentioned that in La Jolla where I live, high schoolers have decided that their leisure activity is throwing scooters off the cliff into the ocean. I'm not kidding. I think 1/5, I walk by the ocean first, there's that pollution, like 100 bikes in the ocean. Those bikes are completely unusable. This is a horrific business model. And I remember asking, one of the people who was one of the lead VCs on it, who invested in it, I said, why do you guys like it? He said, we're collecting big data. I said, what? What exactly are you collecting? So we know when you get on the scooter and where you get off. I said, really? That's what you're collecting? You think you're the only person who's collecting that? You know how many apps on my iPhone track me? I just look at it every morning just to terrify myself. There are like 27 apps that know where I am at any point in time. Yelp knows where I am. Every map program I use, this is the price you pay for free GPS, is Google Maps, Waze, Apple Maps. Though Apple Maps sometimes put me in Kazakhstan. Don't ask me how that happens. There's nothing special about you. This is big data without a point. So when people talk about big data, they act like collecting data is by itself useful. But unless that data is exclusive and you can do something about it, remember learning and adaptive behavior? Let's not even talk about big data. What are the two companies that use big data the best? One you probably watch every day. I'll give you a clue. Netflix. What data does Netflix collect on you? Pretty much everything you watch and everything you stop watching. It's kind of creepy on Netflix when you get onto a show and it tells you exactly where you left off. They can track everything you watch and everything you stop watching. You know why that's useful? What do they do with this information? They make content. It's kind of scary again because what they're doing is they're tuning what they produce to what people watch. And so if they see you, if they say a bulk of people stop when they stop watching halfway through the episode 3 of a show, they say, you know what, we're not producing another show like that. So they're collecting data. It's exclusive because only Netflix gets to know what I watch and what I don't watch. And then they use that knowledge to produce content that they hope will meet your needs better. So one is Netflix. The other is Amazon Prime. Amazon Prime, I don't even want to know what they know about me. And I've got 3 Alexas all over my house. That stupid thing is listening in on every conversation. If I'm preparing a conspiracy, Amazon knows before everybody else does. If I'm pissed off at you on a quiz because you've written all over the back page and I yell, Amazon tracks that as well. Okay? But they collect information and they use that information to show you stuff that you might buy. It's that exclusivity that makes those platforms valuable. So keep that in mind because you'll hear people casually talking about, there's big data here, there's a platform here. Don't let them get away with it because big data and a platform are only the beginning. For it to have value, you need that exclusivity, something you can show you can do. So let's pass the option to expand through the test. Is there an option? Yes. It's a second project, not the first project. And the contingencies, the present value of the cash flows from expansion exceed the cost of expanding. You will expand, otherwise you will not. Second, is there exclusivity? It depends. In the case of Facebook, there's a lot of exclusivity. In the case of Bird, very little. In the case of MoviePass, none at all. Right? Varying degrees. And finally, for the pricing test, can I use an option pricing? I can, but I'm really stretching it, right? Why? I can't value the underlying asset. I can't value the option. I can't do arbitrage. I can't do replication. Here I am using an option pricing model that assumes all of that stuff. It doesn't mean I can't put a number on this option, but it's going to be very difficult for me to monetize it. So that's the option to expand. Let's talk about the third and final option. So option today shows up in patents and natural resource companies. Option to expand show up in high-tech, high-growth companies with platforms and exclusive rights. The option to delay shows up in companies which have big investments that they can get out of. It is the only one of the real options that's a put option. Almost every other real option you're ever going to run into is a call option, and here's how it's structured. Basically, if the value of the cash flows on a project drops below what you can get from abandoning the project, here's what you're going to do. You're going to abandon the project and walk away with that abandonment cost. I know it sounds abstract, so let me give you an example. Let's suppose you're Airbus, and I'm Lear Aircraft. Lear produces these small corporate jets, but let's say I've come up with a way of producing small commercial jets, 30 to 40 passengers. So I approach you. I don't know how to do this myself because I've never produced a commercial jet, and you've never produced a small jet, so I come to you and say, let's enter into joint venture. So you play the role of Airbus, I'll play the role of Lear Aircraft. So I'm going to ask you for $500 million, and I'll put in $500 million, and we'll create a joint venture. And you sit down and say, okay, let me work out the cash flows. And based on what you see as expected cash flows, the present value you get is only $480 million. So right now, if I stop, as Airbus, what do you see? You have to invest $500 million. You're going to get back only $480 million. The net present value is therefore minus $20 million. You tell me, no, I'm not interested. But I really, really, really want you as my partner. So I come back with a counteroffer. I say, look, I know you're worried about downside, but here's the protection I can give you. If any time over the next 5 years you change your mind, I will buy your 50% share back from you for 400 million. Do you see what I've given you? I've given you a floor and what you can lose, right? You invest $500 million, you're going to lose, but you can't lose more than 100 million because I've given you the right to walk away from this investment and receive 400 million. I've given you the option to abandon, a put option, where you can sell the project, your share of the project, back to me at 400 million. Under what conditions would you do this? If the present value of the cash flows collapses to below 400 million, you're going to, and I'm going to give it to you for 5 years. This is a 30-year project. Why don't I give you the right to abandon for the next 30 years? Because what are you going to do then? For the next 29 years and 364 days, you're going to be my best friend. So I love this partnership, I love this partnership. About 6 hours before the end of the project, you're going to show up and say, I never liked this partnership. I'd like to get the 400 million, please. If you're going to give the option to abandon somebody, make sure it doesn't run through the last day of the project, because then you're going to pay a hefty price. So I'm going to give you the option to abandon for 5 years. And because I'm uncertain about how the small corporate jet market will evolve, let's say the variance in the cash flows is 0.16. The project itself lasts 30 years. Let's see what the value of this put option is. What does it have to be for you to be even interested in taking the project? What was the net present value before I introduced this? Minus 20, right? 480 minus 500. So basically, remember, the initial investment was $500 million. You get 480. So minus. So the value of the put option has to be at least 20 million for you to be even interested. So I value the put option. And here's what it looks like. Remember, it's a put option. The S here is the 480 million. The strike price is the 400 million you will get if you abandon. This is an in-the-money option or out-of-the-money option? Got a 50-50 shot. It's out of the money because it's a put option. Remember, you get the right to sell. The S has to be less than 400 million for this option to be worth money. It's an out-of-the-money option. But you have 5 years to play the game. The variance in the value is 0.16. And each year that you wait, remember, you have fewer years of cash flows left. It's a 30-year project. It's a finite project. It will become 29, 28, 27. So the cost of delay. And let's say the riskless rate is 6%. I value the put option. What I get as a value for the put option is $73 million. So juggle the numbers. Net present value of the project as a joint venture is minus 20. But because I've given you this put option, it's become plus 53. You're likely to take the project, but what do I have to be careful of as Lear Aircraft? I've sold you a put that's worth 73 million. I better have a present value that covers whatever I think from the project plus 73. And this is one of the reasons you got to be careful about salespeople gone crazy. In many companies, here's what happens. Salespeople get commissions from selling stuff. So I try to sell you stuff, and I try to sell you stuff, and you're not interested. So I sweeten the deal by doing what? Say, if you buy it, we'll buy it back from you at 20, because it costs me nothing to offer you all these guarantees, and then I walk away, and I register it as a sale, and I collect my commission, and I move on. And you as a company are stuck with all these sales contracts where people can walk away from the contract if things go bad. If you offer these escape clauses, you're paying for them as the person's. You got to build in enough value to cover them, otherwise you're going to be in serious trouble. Okay. And finally, let's talk about what this means for valuation. Again, with all of these real options, I want to caution you, it's going to be very difficult for you to actually get a number for an option because the inputs are so messy. But just realizing there's an option might be the biggest insight, right? Facebook, I'm not going to value the option to expand, but knowing it's there, change my action. With the option to abandon, here's how it plays out. What you have in the option to abandon is the right to walk away from your mistakes. It's basically the value attached to being flexible as a company. There's a reputation that Goldman Sachs had in the old days, especially pre-2008. And here's what the reputation was. That when things went bad on an investment, they almost always seemed to get out sooner than everybody else. The conspiratorial minded said that's because the Secretary of the Treasury is always a Goldman guy. Maybe he calls them and gives them advance notice. Whatever the reason, they seem to escape. So when you had big losses, every other bank would be reporting 3 billion, 2 billion, 1.5 billion. Goldman said, we lost 75 million because they got out. So when things went bad, they were able to get out soon. And when they did something good, they were able to build on it much more than most other investment banks. So on the upside, they got call options. On the downside, they got put options. It's basically the value of flexibility. So how does it play? When you do a discounted cash flow valuation of Goldman and another financial service companies, the numbers might look exactly the same. And I might arrive at the same DCF value, but guess what? I'd be willing to pay a premium on that DCF value for Goldman because it's more flexible. So when you want to value managers who are nimble, who react quickly to what's going on, this is how it's going to pay off, is you're going to attach a premium to the DCF value saying, if managers are quick in responding to what's going on around them, it shows up as a higher value because I'm getting options in this company. And if you're a company that has to have a lot of long-term investments, here's what this particular option to abandon gives you as advice. When you have long-term investments, try to build in escape clauses. Try to make your cost structure more flexible. Try not to lock yourself into long-term contracts, because the more escape hatches you have, the greater the value to the option to abandon. And I might attach a higher value to you as a company if you build those escape hatches into your projects than you've chosen not to. So that's the option to abandon, and that kind of covers the spectrum: option to delay, option to expand, option to abandon. It's really, I mean, even if you don't attach numbers, it's that insight that you bring in saying, hey, that's why I might pay a little bit more, why my actions might be a little more free, a little freer with this company as opposed to this one. Any questions on the option to abandon? Final set of options. Let's talk about options in capital structure. The other class I teach is a corporate finance class, and we spend about 7 sessions on capital structure, financing, mix, right type of financing. And most of the options that show up in capital structure tend to be options you add to bonds. You make a bond, a convertible bond, a callable bond, a puttable bond. In fact, fixed income valuation is mostly option pricing, because basic options, it takes about 5 seconds to value a bond. Basic bonds. It's the options you add on top of it that makes fixed income messy. I'm not interested in talking about those options because that's for a fixed income class. I want to talk about another aspect of capital structure where option pricing can give us some insight. Right? One of the things I do when we talk about capital structure in corporate finance is we talk about the optimal debt ratio for a company. Right? And the optimal debt ratio, if you use basic cost of capital, is the point at which your cost of capital is minimized. So let's play a game. Let's assume I'm a company with a 10% debt ratio, and you compute my optimal debt ratio, and you tell me it's 40%. How do you sell it to me? If I go to the 40% debt ratio, what do I gain? I have a lower cost of capital and a higher value, right? And I say, look, I know, but I don't want to go there. And I'll tell you why. I tell you because I want to maintain financial flexibility. Now this again is a buzzword. You're saying, what does that mean? But let me put some flesh on it. Basically, I want to preserve that excess debt capacity just in case. Just in case what? A great project comes along. I want to be able to take that great project. Having that excess debt capacity is going to help me. Or a terrible time comes around. To survive that bad time, I might use that excess debt capacity. So a lot of companies use financial flexibility as their defense for why don't you go to your optimal. In fact, in my corporate finance class, everybody picks a company and they do the optimal debt ratio. And every semester you get about 75% of companies come out as under-levered and about 25% come out as over-levered. So there's a disproportionately large number of companies, and I think it actually makes sense to be under-levered rather than over-levered. So when I first heard this term of financial flexibility, it stopped me because how can how do you say financial flexibility is a bad thing? It just sounds so good. So I started thinking about how would I value financial flexibility. So I'm going to set up an option pricing structure, and I'm really stretching the limits of option pricing models when I do it, but it's going to give me some insights that are going to be worth the stretching. So here's how I'm going to structure it. I'm going to say, look, let's assume that there's a certain amount of money you're able to raise without financial flexibility. You have internal or external constraints. The most you can raise any year is $150 million, either from internal financing or from external financing. That's your limit. So if you had no financial flexibility and a project came along that required a $300 million investment, you just had to turn it away. So let's assume you have financial flexibility. What does it allow you to do? If that project comes along that requires more than $150 million, you're going to be able to take that project. So what financial flexibility does, it gives you this right to take projects which are bigger than what you could have raised with internal funding. But the right to take a project by itself can be worth nothing, it can be worth a lot, it can be worth less than nothing, depending on what? How good that project is. And in capital budgeting, we measure the quality of a project by its net present value, the excess returns. So here's what the value of financial flexibility is. It comes from A, the fact that you can take projects that you otherwise couldn't have taken, and the excess returns you can make from taking those projects. You need both pieces of the puzzle. So if you get a chance to take big projects that have big positive net present values, that in fact is the value created by having financial flexibility. If I can somehow come up with a number for it, then I can look at it relative to what you give up by having a low debt ratio. Remember, you had a much higher cost of capital, and maybe I can tell you whether the trade-off works in your favor or works against you. So I'm going to use an example, and this is from way back in time, one of my first corporate finance, one of my first editions of my applied corporate finance book. And the company I still use is Disney. I computed an optimal debt ratio for Disney. They were at an 18% actual debt ratio. The optimal debt ratio I came up with was 40% debt. So at an 18% debt ratio, they're at a 12.22% cost of capital. And if they go to the optimal, their cost of capital will decrease to 11.64%. So if I were making a sales pitch to Disney, I'd say, look, you should go to 40% because if you do, your cost of capital is going to go from 12.22 to 11.64%. They say, no, we're not going to do it because we value financial flexibility. So if I value financial flexibility on an annual basis, that value has to be greater than 58 basis points for it to make sense, right? So if I can sum up with a number in financial flexibility, I can weigh it off against the cost of having that financial flexibility. So here's how I did it. And as I said, I'm going to stretch every single definition and option pricing to be able to do it. The S in my model is my annual reinvestment needs, those projects that come along. And that could be high in one year, low in another. So I'm going to look at what you reinvest back in acquisitions, capex, working capital as a percentage of value. So that becomes the S. The K in the model becomes what I could raise with just internal, so the normal access to funds. So I put a K limit. The variance becomes a variance in my reinvestment needs because it will be high in one year, low in the next. And finally, I'm going to do it on an annual basis so I can compare it to my 58 basis points. So S here is the reinvestment needs computed as a percent of value. K becomes what I can bring in as cash without using excess debt capacity. And T becomes 1 year. Here's what the numbers look like for Disney. The average of the reinvestment as a percent of value over the last 5 years was about 5.3%. I wanted to get a measure of good years and bad years. So on average, Disney reinvested about 5.3% of its value into net capex and change in working capital. The standard deviation of that number, the variance of the number was huge, 0.375. Why was it so big? Because in one of those years, Disney bought Cap Cities for $18.5 billion. That created a huge reinvestment that year. My K here was what I could get with retained earnings and cash flows, basically, and that was about 4.8%. So if they had no excess debt capacity, they'd have to stop at 4.8%. By having this excess debt capacity, they're able to go above it, and T is equal to 1. What I got as my value for the option was 1.6092%, which is kind of meaningless because it doesn't, that's the value of taking the project. But remember, the value of a project comes from the fact that it earns more than the cost of capital. And I measured how much they earn more than the cost of capital by cheating. I looked at their actual return on capital and compared to the cost of capital and said, if that's what they're making on their existing projects, that's what the new project will make as well. And that's a stretch, but I used that. And that gave me a value for flexibility of 0.85%, layer upon layer of assumptions, right? The first is I'm doing the value of the option to take a project on a 1 year basis. The second layer is I'm assuming that what you've made as excess returns in the past is going to be your excess return in the future. But with those assumptions, the value of flexibility is 0.85% of value. How much am I giving up to keep that flexibility? 58 basis points. I'm getting back 85, I'm giving up 58. To the extent I trust these numbers, you know what I'm going to tell Disney? You're right, don't go to the 40% debt ratio. The value of financial flexibility is worth more than what you would get by moving to the optimal. Again, to do this for individual companies, the numbers can be incredibly messy, but think of the insights you can get out of this process. In fact, I'm going to give you a set of implications about the kinds of companies where the financial flexibility argument has the most oomph to it, and the kinds of companies where I'm going to say, look, I don't care about financial flexibility for you. First, it depends on what kind of capital constraints you face. In fact, in the case of Disney, you know what my pushback would have been? What is this artificial constraint where you said you can raise only 4.8%? You know why that constraint exists? It's because you refuse to issue new stock, because you're worried about dilution, you refuse to borrow more money. If you view Disney as having access to capital, as much capital as you want, you know what the value flexibility would become, right? If you can raise, it goes to zero. So here's my first implication. If you're a large company with access to capital markets, you should value financial flexibility less than a small company with limited access to capital markets. If you're a private company, you should value financial flexibility more than if you're a publicly traded company. If you're an emerging market company, you should value financial flexibility more than a developed market company. If you're a company in the middle of a crisis, you should value financial flexibility more than if you're a company that's not in a crisis period. Financial flexibility can vary across companies depending on size, depending on geographical setting, depending on timing. So that's the first implication. Just tell me something about your capital constraints. I'll tell you whether financial flexibility should be worth any money to you.
So you talked about it in two different ways.
Right.
One was taking on the debt for a new project, and then you said there was also debt in case of something bad happening. Is there a way to kind of...
That's a put option. So you'd have to do a put option on the, because when you talk about something bad happening, you're talking about the value of the firm falling below the outstanding debt and being, remember the truncation risk we talked about? By having financial flexibility, maybe you can avoid that. Right? But they're both options, and the same implications will apply to both. Second, the more unpredictable your reinvestment needs are, remember the value of the option comes from that, not just how much reinvestment you have, but how much it varies across time. The more you should value financial flexibility. You're saying, where is this going to show up? If you're a power company and you know what your investment needs are going to be for the next 10 years, you have 3 power plants, you know what, you should value financial flexibility less than a technology company which says, right now we don't know what we'll need, but things could change dramatically. The more unpredictable your reinvestment needs are, the greater the value to financial flexibility. What did I say caused Disney's standard deviation in that number to be a high number? What did they do? They bought. Any acquisition-driven company will value financial flexibility more than a company that grows with internal projects. Because internal projects, almost by definition, are more predictable, right? They're small. You take 5 a year. Acquisitions, it could be 20 billion one year, 3 billion the next year. So if you grow through acquisitions, you will value financial flexibility more. But here's the final and most critical factor. When you talk to me about how much you value financial flexibility and how, why you're not borrowing money, I'm going to ask you a very simple question. What was your return on capital last year? What's your cost of capital? If you say return on capital is 9% and your cost of capital is 10%, you know what I'm going to tell you? I don't want you to have financial flexibility. I want you to have as little financial flexibility as possible because I don't want you even to think about taking projects. So the third and final factor is tell me what business you're in. If you're in a business where it's really difficult to make the cost of capital, don't even give me this financial flexibility argument. It doesn't fly. So look at the capital constraints, look at the unpredictability of reinvestment needs. And this is a great way to kind of, because CFOs use this all the time. I want financial flexibility. Don't let them get away with it. Because in a sense, for some companies, financial flexibility has value because they're limited access to capital. But if you're a $500 billion company and you talk about financial flexibility, I don't even quite get that. So look at the company to make the judgment on whether financial flexibility actually has teeth. Any questions on valuing financial flexibility? Now comes the final example of option pricing. Okay? Some of you are valuing companies that are truly basket case companies. What sense? They're money-losing companies. They have a huge amount of debt. Okay? In fact, this morning somebody came to me with a company that's 98% debt, 2% equity, market value terms. It's losing money. It has an immense amount of debt. There's no light at the end of the horizon, really. And when he did this DCF, guess what he found, even with optimistic assumptions? The value that he got for the operating assets was well below the outstanding debt. He got a negative value for the equity. He tried pricing it then by using an enterprise value multiple to revenues. Why revenues? Hey, because everything else is negative. He came up with an enterprise value, but the enterprise value was less than the debt. His pricing told him the equity was worth nothing. This morning he came to me and said, can I complete the project? I have a negative DCF value, I have a negative pricing value. Can I conclude that the equity is worth nothing? I said, before you do that, there's one final test to run. Why are people buying? The stock is still trading. Either these people are insane or they're buying this equity for a very different reason than you're buying equity in a traditional company. Normally when you buy equity in a traditional company, you buy it for the cash flows or you buy it because it's priced and cheaper. Why are you buying equity in this company?
Maybe that you can get the residuals.
No, remember, if you liquidate the company today, there's going to be nothing left in the company, right? Because in a sense, the value of the operating assets is horrific. You're buying it because you hope something good will happen, and you're buying it because you pray something good will happen, and most of the time nothing good happens, but you're buying it for the same reasons you buy a deep out of the money option. What are you hoping? That something good will happen, and the value is not going to go to 80% of the value, but if it goes from 2% to 8%, you know what happens to the value of your equity? It quadruples. You're going to make a 600% return. If you're a vulture investors invest in distressed debt or distressed equity, you're buying a bunch of options. And when you buy deep out of the money options, most of the time the options exercise worthless, but all you need is 2 or 3 of these options to pay off. Remember the Las Vegas Sands valuation we did in class? Stock was trading at $425. You know what happened to that stock over the next 2 years? It went to $65 per share because the underlying business improved. You're buying an option. So I'm going to argue that equity in these deeply distressed companies cannot be viewed as the present value of cash flows, a DCF, or a pricing. It's got to be valued as an option. So let me set up how that option derives its value. Equity is a residual claim, right? You get whatever's left over after everybody else is paid. That's true in every business. Second, equity gives you the right to, you as the equity investor, run the company. And third, in publicly traded companies, equity has limited liability. What does that mean? What's the worst that can happen to you on a stock? The stock goes to zero. You're saying, that's awful. It could have been worse, right? What if the broker had kept calling you saying, look, the stock is at -2. -5, send in more dollars. That can happen if you're the equity investor in a private business because you don't have limited liability. Your business could be worth nothing, but then what do? They come after your personal assets. Thank God. With equity in publicly traded companies, you have limited liability. So it's a fact that you run the firm and you have limited liability that essentially gives you the optionality. So let me set up the option again. The face value of the debt becomes the equivalent of the strike price. So you get the option to liquidate the company. You're the equity investors. You guys be the lenders. This is a far less fun place to be. But you guys be the sober, conservative guys. You've lent these guys money. They're the equity investors. They're crazy. They get to run the company. They can liquidate at any time. And if you liquidate, what happens? You get the liquidation value of the firm. And if that's greater than the face value of the debt, you get to keep the difference. And if it's not, what do you lose? Whatever you paid for the stock, right? Because you can't lose more than that. So I'm going to use this insight to come up with the value of equity in a distressed company as an option. So let's assume you have a firm where the assets are worth $100 million today. Let's assume that somebody's done the valuation. So if you liquidate the firm today, you're going to get $100 million. Let's assume that this firm has 1 0 coupon bond outstanding. And you're going to see in a minute why I had to make it a 0 coupon bond to make my life easier. Due in 10 years with an $80 million face value. For the next 10 years, you get to run the firm. At any point in time, you can liquidate the firm. You will get whatever the liquidation value is minus 80 million as your payoff. Let's also assume that this 100 million is going to change over time. There's a standard deviation of roughly 40% a year. The T-bond rate is 10%. So I've given you 3 numbers. I've given you the value of the firm at the standard deviation. I've given you the debt that the firm owes, and I've given you the T-bond rate. And I'm going to argue with that limited information. You should be able to tell me how much the equity in this company is worth and what interest rate I should be charging on the debt. I haven't given you cash flows, no cost of capital, no rating, but I'm going to argue you don't need any of that stuff. And here's how you're going to be able to get the two numbers. What's the value of the overall firm? It's $100 million. What do you have as equity investors? The right to liquidate the firm at any point in time. And if you and you get the right for how much time? For the next 9 years and 364 days. You see why I made it a zero coupon bond? Because you have a regular coupon bond, what do you have to face? Every 6 months you got to make coupon payments, which holds you accountable. Here I've said for the next 9 years and 364 days, this is your company. At the end of the 10th year, the power shifts back to the lender. And the value can go from 100 to 150 or 40 or whatever it is. So here's what the option looks like. The S is 100 million. The K is the 80 million you got to pay if you liquidate the firm. The T is the 10 years, the life of the bond. The variance is the variance in the 100 million. So it's 0.16. And the T bond rate is 10%. I have everything I need to value the option, right? S, K, R, T. There's no dividend here because the company's now, if they paid a dividend, I could throw that dividend yield as well. I valued the option. I get N of D1 and D2, N of D1 and N of D2. Do you remember how I described N of D2? What did I say it measured? A probability that S will be greater than K. What's S here? The value of the firm. What's K? The face value there. There's a 63% chance that the value of the assets will be greater than the face value of the debt, which means there's a 37% chance of what? What happens with of bankruptcy? So from the option pricing model, I can give you a probability of bankruptcy. There's 37%. There's an outfit on the West Coast called KMV that does this for banks. So if you're a bank and you have a loan portfolio and you want to get a probability of default, which for banks is a big deal, you can take it to KMV and they take it in this room with no windows and a secretive model. They run it through the model and they give you this magical number, 23.35% probability of default. And you know how they do it. They run it through an option pricing model. They take N of D2. That gives them, and 1 minus that number will give you the probability of default. There's a 37% chance of default. Even though today it's not defaulting, the value is greater than 80 million, because there's variance, there's a 37% chance of default. With that ND1 and ND2 built in, I get a value for the call of 75.94 million. What is that telling me? That's the value of my equity. And if the value of the firm is 100 million, the value of the equity is 75.94. The difference between the two is the value of the debt. And because it's a zero coupon bond where I get 80 million in 10 years, if I can give you the value today, you can back out the interest rate. The interest rate is 12.77. Magically, with the option pricing model, not only am I giving you a probability of default, I'm telling you the right default spread you should be using on this company. It's 2.77% over the risk-free rate. I've given you the equity value. But I kind of cheated, because what was the number I started all of this with? I gave you the value of the firm. So we'll have to come back and deal with how do you get that stuff, because without that the whole thing comes apart. But essentially I've divvied up the 100 million between equity investors and lenders, and I've told you how much the equity should be worth. So let's say you trust me, bad mistake, and you buy the equity for 75.94 million. See, we did an evaluation class, he said it was worth 75.94, you buy it. And tomorrow you wake up to a catastrophe. Half your company has disappeared. Don't ask me how that happened. There are 2 factories, one in Florida, one in California. Take your pick. Hurricane or earthquake, one of them is gone. Not insured. The value of your business goes from 100 million to 50 million. Is this good news or bad news for you? That's not a trick question. Unless you have a very perverse definition of good news, this is obviously bad news. Your equity was worth 75.94 million until 5 minutes ago. Now I've given you the bad news. Let's start with the easy question. What's going to happen to the value of your equity? It's going to drop. Right? It was 75. But the question is, how much will it drop? And I'll give you the choices. It can drop by 50 million. After all, you've lost 50 million in value. 75.94 becomes 25.94. The first choice. The second is, the accountant, if you ask him what happened to my company, he's going to go through your book value and he's going to write off 50 million. He's going to tell you your book equity is negative. And you said the equity is worth nothing. So the second scenario is your accountant's going to tell you your company is done, you might as well shut down and sell your equity for nothing. And the third is, to finish off the choices, is your equity can drop by 50 million, can drop by more than 50 million, or it can drop by less than 50 million. in which case somebody else has to be bearing the remaining amount, right? Because the loss can't go, it has to go somewhere. So if you bear less than the 50 million, who else is in this game that you're going to drag in and say, why don't you share some of my pain with me? And you're saying, no, please don't drag me in. I don't want to be part of this. And he said, no, we're a family. Just come into the room. So let's work out exactly how much the equity is going to be worth. But before I do that, you had a question?
Oh, no, I just thought that it would probably be worth more.
We'll see what, in fact, let's see what it works out to. Because it's an option, right? It's the same option as I had yesterday except for one change. I still have the same K, the same T, the same R, the same sigma. Because remember, it's two factors, so standard deviation is a percent. But my S becomes 50 million. So let's value the option. Remember what it was, 75.94 million before. When I value the call, I get 30.44 million. $45.5 million less than I did yesterday. What was my probability of bankruptcy before this happened? 37%. Now it's 58%. No surprise if half my company is drawn. And remember that 20 point something million I had, 24 million that I had for the bonds, they're now 19 if I back out the interest rate, it's now going to be 14 or 15%. So my equity is worth less, but so are my bonds. The probability of default has gone up, and the interest rate I would charge on my debt would be much higher. So when my value drops by 50%, my equity is going to drop in value. And once I got started in this process, I could not stop myself. And here's what I couldn't stop myself on. I said, what will happen if the value dropped to 40 million, 30 million, 20 million, 10 million, 5? You know what I was trying to find? When does equity become worthless? When do I give up on this equity? Remember, I still owe the 80 million on the bond, right? And you know what? I kept trying. I dropped the value of the business to 2 million, and the equity hung in there. It's an incredibly stubborn instrument. It wouldn't go away. So what's keeping the value of equity afloat in this company? One is hope, but let's add to it. One is time. I have 10 years. And the third is that the value can change. Hope, time, and uncertainty keep equity afloat. It gave me an entirely new perspective on what bankruptcy means. Because I used to think bankruptcy meant that the value of your assets is less than the value of your outstanding debt. In fact, my daughter, when she turned 24 day before yesterday, but when she was 3, she's an incredibly brilliant financial genius. When she was 3, actually showed me that the true definition of bankruptcy. It was a summer. I don't know what we were doing that summer, but I must have had a lot of time on my hands because I would play Monopoly with my 2 older sons every day. Yeah. We'd sit for the afternoon, and Monopoly takes forever, especially when you're playing with little kids. And my daughter would insist on joining in. Tiny little person, horrible temper. She joined in because she wanted to. Finally, she was persistent, so we let her in. And then she acted like a one-person Enron. She would collect $200 without passing go. She would put hotels on properties that didn't belong to her, ask you to pay rents for things that weren't hers. And finally I said, Kendra, you're banned. Get out of the game. And she got up and she's furious. She walks out, you're bankrupt, you're bankrupt, you're bankrupt. And I'm very impressed that a 3-year-old would use the word bankrupt. I said, Kendra, what does the word bankrupt mean to you? Expecting an answer like the value of your assets is less than the value of your outstanding liability. And she said, bankrupt means you don't get to play the game anymore. And you know what? She's absolutely right. As long as you get to play the game, you're not bankrupt. These equity investors are not bankrupt. Why? Because they get 10 years to play the game, and who knows what can happen in 10 years. The next time you see stock, so this morning the guy who came in with the DCF value and the pricing said, but how do you explain the fact the stock is trading still? The answer is very simple. As long as it's viewed as an option, there will be value. You know what's going to make its value go to 0? Time. And what causes time to shrink? Basically, the closer you get to that, So, and with a regular company, you're going to see this process get more complex because each debt payment becomes a barrier to overcome. It's a series of options. So it's still an option, but instead of having one big 10-year option, you have 26-month options stacked on top of each other. But the insight you get by keeping it a zero coupon bond still applies, and it's so much simpler just to start with the zero coupon example and work through it. So I'm going to use this insight of equity as an option to talk about why lenders and equity investors will often disagree about very basic things. So let's go back to that original example. So let me go back to the $100 million value. Remember that you had face value of debt of 80 million, and the value we got for the equity was 75.94, and the value of the debt was, so that was the original example. So let's say you're the equity investors, and I come to you with a project. I'm a project salesman. I say, look, I have a project for you. And you're, with your corporate finance pedigree, you ask me the right question, which is, what's the net present value of the project? And it says minus 2 million. You get ready to throw me out. Say, wait. Not only is it a bad project, it's a risky bad project. Now your instincts are kicking into full gear, saying, not only am I throwing you out, I'm banning you from my premises. But before you throw me out, think about what this is going to do to your company. If you take this project, what's going to happen to the value of your overall company? It was 100 million before. When you take a negative net present value project, 100 million is going to become 98 million. Saying that's bad. But it's a risky project. And let's assume that what it does is it increases your standard deviation from 0.4 to 0.5. In other words, it goes from 40% to 50%. Your value as a company drops by 2 million. Your standard deviation increases from 40 to 50%. You're the equity investors in this company. Here's the magic. You just took a bad project. You took a bad, risky project. You should be punished. You should be put into the layers of corporate finance hell. But here's what happens to you. Remember the 75.94 million you had before? It's now jumped to 77.71 million. And where did the increased value come from? You essentially ripped off your bondholders. You know the lesson I get from this? If you're a lender on an LBO, don't let the LBO guys run the company. I see bankers do this. They say, what's wrong with you? You let an LBO guy, he owns 20% of the company, take big decisions. What's he looking for? Big payoffs, because if he gets a big upside, he owns the upside. If he gets a big downside, what does he say? Limited liability, take whatever you can. There's nothing here. But people do this all the time. They lend to highly levered individuals. Real estate is the same thing. I would never lend to a real estate developer, the amounts that they do, because you're letting somebody play games with a small slice of your business. And it's not that they're bad people, but what's in their best interest is not going to be in your best interest. So if you want to illustrate the conflict of interest between lenders and equity investors, it's a great way to do it. You say, no, in fact, set it up. You take a bad project, you take a bad risky project, I come out succeeding. No. And that's pretty much what I'm getting here. I'm getting the increase in value because I essentially ripped off my bondholders enough that I covered up my negative net present value. That's why you can maximize the value of equity while reducing the value of your business. You can do things that actually make you better off at the expense of the overall company. Let's do one other example to kind of illustrate how basic things we're taught in corporate finance can get shaken up by bringing in this option pricing. So let's go back again to the original example. Remember $100 million value, 75.9 more million. Let's suppose I come to you with a potential target firm to acquire. This target firm has a value of 150 million, and you buy it for exactly 150 million. It's a fair value acquisition. What should happen to your stock price? It should remain unchanged, right? Because it's a fair, in fact, that's the way we're all taught corporate finance. If you take a zero net present value project, your value of equity, let's see if that is in fact true.
Your value should decrease. If
And tell me why it might decrease.
if under the assumption that you paid all cash for 150 million.
Well, yeah, let's not, that brings in other issues. There's actually another reason it happens.
Could fail. This company, maybe you misvalued this company.
No, we valued it right, 150 million. So I'm not going to let you any escape hatches. There's no cash financing. But here's what could happen. I have two companies here, right? Company A and Company B. I've got the values. They're in two different businesses. No two companies, even if they're in the same business, are perfectly correlated. So when I combine the two companies, guess what happens to my standard deviation? Remember the two asset portfolio? Every finance class starts with this. If you think about firm A as the first asset and firm B as the second asset, and I put a correlation of 0.4, the standard deviation I get, or the variance I get for the combined firm, is lower than the variance of the, it's not magic, it's just pure diversification. Now by itself, that doesn't create value or destroy value. That's why you didn't see the value go up. But as an equity investor, remember you have an option. So basically you had options on two risky companies. You combine them and made them a safer company. Guess what happens to the value of your equity? So there are the values of the equities in the two firms standing alone. By combining them, the value you got was which is about $3 million less than what you'd have got as standalone equity investors. Who gains from this? And why do they gain? Give me the intuition as to why, as bankers in this combined company, you're feeling much better.
Because the standard deviation is now lower.
And you charge the same interest rate you did before, right? Basically, you were lending to two risky firms. So to counter this, when you do an acquisition, and this is a conglomerate acquisition, what do you need to do as the acquiring company to claw some of the value back? First is, yeah? One is use more debt, right? That's one way in which you can essentially transfer. The other is go back to the bankers and renegotiate the interest rate in your debt. Say, look, you lend me money at 8% to two risky firms. We're now a safer firm. Because if you don't do this, and you go on a conglomerate binge of buying company after company in different businesses, you're going to end up making your equity investors worse off, even if you pay fair value. So we're not even bringing in the premium effect. Just doing a conglomerate acquisition binge will make you worse off as an equity investor because you're going to be transferring wealth to the lenders as you go along. The reverse is actually true when you break up a conglomerate. You can actually gain as equity investors, and this is going to be true in the GE breakup if it happens, because those lenders were lending to a consolidated company and now going to be in different companies. So the lenders are going to be the ones who have the veto power in this process because they're not going to sit there saying, oh, give me whatever interest rate we had before. They're going to renegotiate for higher interest rates, and they should. So when you think about what happens with options, it gives you a way of kind of breaking out why, so it's a good trick question. Can a fair value acquisition affect your stock price? Yes. If you don't adjust for the leverage and you don't adjust for the fact that equity has optionality. Yes?
So what about if you bought back some of the debt that the debt holders previously had?
Well, it's the same thing as retiring the debt. You have to replace it because otherwise your debt ratio will go down. So if you retire it and replace it with new debt, it's the same thing as renegotiating with the bankers, right? Ultimately, you need that debt in there because if you bring your debt ratio down, that's going to make the problem worse in many ways because then you have a cost of capital effect to worry about. Right? Any other questions? Yes?
So if a food company bought a tech company,
No, anytime you combine two companies, the combined company's leverage is going to be lower than the weighted average. So if you it might be higher than the food company's standard deviation, but remember your bondholders in both companies, right? So it's a combined company standard deviation. So the simplest way to think about it, let's say you have a 20% standard deviation company buying a 50% standard deviation company. Food companies, right? Your combined company is not going to have a standard deviation of 35%, which might, even though they're equal sized companies, it might be as low as 22 or 23% or even lower than 20%. So whatever the combination is, that standard deviation is going to be lower than just combining the two companies because they're not in the same business.
But if you increase your debt before buying the tech?
Well, the question is if you increase your debt and you buy the riskier company, that debt will reflect what you're doing the acquisition for, right? So the interest rate on the debt will not be the old food company cost of debt. I mean, how do you keep them in the dark, right? Preemptive, but then you're going to be a riskier company. They're going to be lending you money as a riskier equity in that same company. Your standard deviation as an equity investor will still be higher. So if you do the higher leverage before you do the acquisition, unless you can lock in the interest rate on that debt, and that might be what you're thinking about, you're not going to be able to get away with it. So you might be able to, if they were stupid enough to lend you the money assuming you were going to be a food company, and then you went and bought a tech company afterwards and didn't protect themselves. I mean, that happens in a lot of deals, is leveraged deals rip off lenders simply for that reason. Okay. Any other questions? So if you wanted to apply this for a real company, the question is, I mean, the example I gave was incredibly abstract. I gave you the value of the firm. I made it one nice zero coupon bond with a face value that was given. I told you what the life of the bond was. I gave you the variance in value. And if I gave you all of those things, it's easy to work through the option pricing model. Okay? So, but remember this, the guy this morning who came to me with a company. If he wanted to apply the option pricing model on his company, he'd have to get all of those inputs for the company. And actually I told him most of the work he's already done. Because here's what I need. I need a value for the firm. Does he already have that? From his DCF value. You got a value for the firm, so basically it'll be a DCF value before you get, so not the equity value from the DCF, but the value of the operating assets. That becomes the S in the model. If you want to cheat, you can even do pricing, right? You can say typically these companies trade at 6 times EBITDA, 3 times revenues, apply a pricing, but that's going to give the S in the model. So if you have a distressed company, you can either price the assets or you can do a value, or you can do a sum of the parts if you want to, a liquidation valuation. That gives you the S. The K, though, is going to be tricky, right? No troubled company in history has ever had one nice zero coupon bond with a face value that's given. If you're a troubled company, you have debt from like 50 different places. You know why? Because you got desperate. You borrowed from anybody who would lend you money. So you got 50 different debt issues. And you can't do an option pricing with 50 different debt issues. So I'm going to cheat. I'm going to make it into one nice zero coupon bond. This is going to be quite tricky. I'm going to add up all of the debt you have due and make it the face value of the bond. I'm going to take a weighted average of the maturities, or if I want to be precise, the durations of all of your debt, and make that the duration of the maturity of the zero coupon bond. And if I can do that, I've converted your complex, messy debt into one big zero. I'm cheating like crazy doing this. But I can replace your debt with one zero coupon bond with a duration equal to the average duration of all of your debt. I'm almost there. That duration then becomes the life of the option. So I've got SKT, and now I'm stuck on the variance. Remember how I valued Royal Dutch? I took the oil price, and then I did a simulation. One of the nice things about a simulation is what do you get as output? I get a value for the firm, but I also get a standard deviation of value. So one way to get that standard deviation is to do a Monte Carlo simulation. So if I told that guy this morning to do it, he'd have freaked out. He was already almost at breaking point. So I gave him a suggestion. This company is a troubled steel company. You know how we got betas for companies? What do? We came up with the bottom-up beta by looking at betas for steel companies. I actually have bottom-up variances by firm, by sector. So if you go to my website, I have variances in firm value for steel companies. And I said, you know what? I know this isn't perfect, but you have a steel company. You're worried about the uncertainty about value in the steel assets. Why not use the variance in those? Yeah. I just get the variance by looking at the actual stock price variance over time. So basically I have that in Capital IQ. You can get the standard deviations. I get the standard deviation of the equity and the standard deviation of the debt, and I compute a variance in firm value for every company, and then I do the pivot table. And I do this precisely for this reason. I will have troubled steel companies, chemical companies. I mean, if you're in India right now, Jet Airways, airline, it's already gone. But before it was gone, you could think about the equity in that. Variance for airlines. So it's cheating, you can do that. The third way you can get this variance is if your stock and bonds are traded in the company. You can get the variance in the stock price from the stock market, the variance in the bond price from the bond market, and you can compute a variance in the firm value. You got to then compute a covariance. So it's a pain in the neck, but you can do that. That's why I suggest if you have trouble, so just go to the. So you got S, you got K, you got T, you've got the sigma. The riskless rate, you pick whatever riskless rate corresponds to the duration of your debt. So if you have 4-year debt, then basically find a T bond with a 4-year, basically use it as your risk-free rate. That's basically how I'm going to get the input. So when we come back on Wednesday, I'm going to try to get these inputs for a real company. You can see it play out. And then we're going to use that to extract information. If you're investing in distressed equities, what kinds of companies do you want to invest in? Because the insights are going to emerge very quickly by looking at what drives the option value. Okay? not somebody tossing a coin. You pick the one. So basically, pick whichever one gives you lower